Welcome to this webinar from billions to trillions, the climate finance we need. You have to do with me today because it was said that Friederike Reuder from Global Citizen would moderate this discussion. But unfortunately, she's not able to, so I'm stepping in. My name is Rens van Tilburg. I'm the director of Sustainable Finance Lab, academic think tank from the Netherlands. And we organized this program together with Global Citizen and with Beyond Bretton Woods, a US-based organization of which I also am a member. Well, we're meeting at a very important time because later this week, as you know, in Dubai, the COP28 will start, and we think it will really become a climate finance COP. Where, like last year, a lot of discussion will be about who is going to pay for what. We are very strongly of the belief that the discussion needs to shift from the current one about the billions to actually the trillions that are really needed to get the energy transition going at the speed and in an inclusive way as it is needed. So fresh thinking is needed, and that's what we try to bring to the table with this webinar and also with the report of Sustainable Finance Lab that we published today. In a minute, you will find a link to that in the question and discussion part of this program. The program of today will consist of two presentations, very short presentations, and then two discussions with a international panel. The first presentation and discussion will be more of a general view on the climate investments, and then the second one will have a much more strong focus on, in particular, the special drawing rights. Now, the first presentation will be of my colleague Sara Murawski, a researcher at Sustainable Finance Lab, and the second presentation will be by Tirivangani Mutazu, an independent researcher from Zimbabwe who has done research into this topic of special drawing rights use in Africa at our request. And we have a very good panel, I must say, including Vera Zongwei of the Brookings Institute, who is also a member of the independent high-level expert group on climate finance. So she will be joining a bit later because, as I understood, she's until now presenting their new report to the media. We have Hazatu Nzele, the Chief Financial Officer of the African Development Bank. The African Development Bank that has developed a specific proposal on how special drawing rights could be rechanneled to multilateral development banks. And then we have two people from European treasuries, so of the Dutch Ministry of Finance, Jesper Hansen, and from the French Treasury, William Roos. As I said, first of all, I would like to ask everyone to mute. Given that we are with a lot of people and we have a lot to discuss, I want to ask if you have any comments or questions that you'd like to be asked, put them in the Q&A box, and then we will see if we can bring them into the panel discussion. But also feel free to react to each other in the Q&A space to make it as interactive as possible. And I think with that, I would like to give the floor to my colleague Sara to do the first presentation. Sara, please.
Yeah, thanks a lot, Rens. Let me just share my screen with you. Yeah, supposed to be working. Great. So today we will be discussing our newly launched report, From Billions to Trillions, the Climate Finance We Need, which we've written in collaboration with Global Citizen and Beyond Bretton Woods. And we launched it just ahead of COP, focusing on what can be done in the short run to make sure that all countries are able to transition towards green economies, but we also look ahead at the reforms of the global financial architecture that are needed to enable prosperity for all. So the climate investment gap. What do we mean by that? The climate investment gap refers to the extra investments needed to fulfill international climate goals. And currently, the investment gap for developing countries alone, excluding China, stands at $1 trillion, and it's set to rise to even $2.5 trillion in 2030. Of course, countries also need to take measures in terms of climate adaptation. There will be costs related to loss and damage, and that adds to almost $1 other trillion to this uncovered bill. If we want to realize all the SDGs, including the social ones, that actually adds $1 more trillion to the bill. So this is a staggering amount of $4.5 trillion by 2030 in terms of the climate investment gap for the developing world. And without filling this gap, of course, we will not be able to tackle climate change, whereas a stable climate is a global common goal. If you look at the differences in terms of investment needs, we also know that certain regions which are hit hard by climate change also need the most investments. So Southern Asia needs up to 14 times as many investments as it's able to provide now. Africa 12 times as much. So that's a lot of money. If we look at the current state of the world, it's displayed in this graph very clearly, I think, from the poor to the rich, we call it. So this is the difference between the capital flows going into the developing world and capital flows leaving the developing world. As you can see, it's negative. That means that there's more outflows of capital than inflows. And if you compare it to the official development aid that countries are receiving, it's a multiple. So that means there's much more capital leaving these countries and they're not being compensated sufficiently in terms of aid. And if you would also take account of illicit flows, the numbers would even be worse. So that means that these countries are in a very dire situation in terms of the investment that they cannot make to transition towards green economies. And to make up for these capital outflows, these countries need to borrow money. So that brings us to the next problem, which are the developing countries' unprecedented debt levels. So currently 60% of low-income countries are in or at high risk of debt distress, so they're risking default. 19 countries are spending more on interest than on education, and 45 spend more on interest than on health. That also has to do, of course, with the higher borrowing costs that these countries face, which is called the Great Financial Divide. So whereas Germany or the US only pay a couple of percent in terms of interest, for example, Asia pays 6.5%, Latin America 7.7%, and Africa almost 12%. So that's a lot of money adding to already high debt levels. Now, if we look at the agenda to fill the climate finance gap, given the fact that there's a lot of capital outflows and that these countries are facing high debt levels, we can see here what the current agenda wants these countries to deliver in terms of, first of all, domestic resource mobilization. So that means an extra tax effort from these countries. Getting taxes to invest again in climate and development, and that stands at 400 billion, which is expected from these countries. But if you actually look at the ability of these countries to raise taxes, we can see that tax revenues are actually expected to increase only slightly and not significantly. And many long-standing initiatives to help countries support tax reforms and raise more taxes do not deliver, unfortunately. Also, there's still a lot of tax evasion going on, so we think that this is a rather optimistic estimate of what countries can deliver in terms of domestic resource mobilization. Now, when it comes to blended finance, which is visualized here, that means if you put a public dollar, for example, to the table, crowding in more private dollars, we also see that a lot is expected from blended finance. But we know also, unfortunately, that over the last years, private investments through blended finance has actually decreased in developing countries. And if you look at the ratio, the IMF expects that every public dollar invested is able to crowd in 9 private dollars. But in reality, the ratio in the developing world is often 1-on-1 or even less. So in low-income regions, which require, of course, the most investments, and you can see that also in the second graph here, you can see that the ratios are often 1-on-1, or even, for example, in Sub-Saharan Africa, 80% of climate investments are coming from the public sector, only 20% is coming from the private sector. So we call this the myth of blended finance because we do not see that it's delivering now. Then the question is, if the current agenda is not delivering, what can actually be done and what can be done at the COP? So we've looked at all the proposals on the table, some great reports, for example, the UN's Global Common Agenda. So in terms of taxes, if domestic resource mobilization does not deliver, then perhaps we should look at global taxes. So tackle tax evasion for once, of course, but also a financial transaction tax can be implemented, a global wealth tax, and also the taxation on aviation and shipping needs to be arranged. That was almost done during the climate summit in June. Maybe we can actually finalize it during this COP. If blended finance does not deliver sufficiently, then we should also look at why and what kind of risks we could actually publicly guarantee. So you could think of public guarantees focused on climate-related events, weather events, pandemics, to make a blended mix that actually does work for the developing world. In terms of debt, so unprecedented high debt levels, very high interest rates to pay is needed that countries get a pause in their debt repayments and also in their interests. We also think it's very vital to integrate climate more sufficiently into supervision and monetary policy. So better transition plans, better climate change scenarios. Additionally, the lending capacity of multilateral development banks, so MDBs, can be increased. This is also known as the capital adequacy framework. And last but not least, and this is a proposal I'm going to focus on a little bit because it's something that will be discussed also by other speakers today, is the need to rechannel special drawing rights. Now, special drawing rights are submitted by the IMF. There are claims on central banks and they can be exchanged for currency. And this currency can be, of course, invested in development and climate needs. And during the pandemic, the IMF has created 650 billion worth of SDRs. But most of these SDRs during the quota of the IMF lie idly on the balance sheets of rich countries. The G20 has committed to reallocate 100 billion of SDRs, making use of 2 specially dedicated IMF trusts. So far, only 700 million actually has been disbursed. So it's a very slow pace. Also, the trusts face certain limitations. Fortunately, there's also other ways to rechannel SDRs. And that's why we support the hybrid capital proposal, which is developed by the African and the Inter-American Development Bank, which levers actually hybrid capital at a rate of 4-to-1. So that means that of the 400 billion unused SDRs, we could actually enable 1,200 to 1,600 billion in extra loans that can be invested for climate purposes. Last but not least, and then I will end this presentation, we have also put forward proposals for the long run. So we think that a reform of the global financial architecture is needed to foster development and climate on the planet. I'll not go into detail here, just wanted to say that we also think that a more regular or automated SDR issuance is needed. So also Joseph Stiglitz, a Nobel Prize winner, supported this. You could also think of a construction where in case of extreme weather events, SDRs are issued. And that can actually really help developing countries in crisis situations to make sure that they don't have to become too indebted and that they can actually face the measures that they need. So I'll end here. If there's any clarificatory questions, I'm happy to answer them.
Thank you very much, Sara. That was a very big agenda to do in 8 minutes. So I would like to invite Vera Zongwei to give a first reaction to this, but I'm not sure if she's in the call. I am on mute. And if Vera Zongwei is not in the call yet, then she will probably get here soon. But maybe, Hasatu, can I then ask you to give a first kickoff for the discussion?
Okay, thank you very much. And thank you very much for having me with you today. This is a very important conversation. And, it has taken a lot of, it's been on the spotlight. And I do hope that this time the world is really going to get it right because we cannot afford to fail given the implications that we see. There's been a lot of commitments, a lot of promises, but inability to follow on this. And there are valid reasons. There may be valid reasons, but there are opportunities that we cannot afford to ignore. So I really appreciated the presentation, Sara, and I really like what you said about domestic resource mobilization. So yes, it's not the panacea today. It's not something that is short term, but it's something that I think African countries, at the very least, or low income countries, emerging market countries, really need to look at, because there are lots of resources that can be mobilized and that can be made available if we ensure that we have the right governance and the right legal environment in order to be able to manage that the best. So domestic resource mobilization, absolutely, it is a medium to long-term path to for these low-income countries to achieve development. So you cannot rely only on public sector money, or even on private sector. Actually, you can look at private sector money, but then you need to find an efficient way of mobilizing that. And as you've rightly indicated, the numbers have not really worked for us, because in terms of blended finance, we're not there. So the question is, what it is that is needed in order to have blended finance work and have the leveraging capacity that is more than 1-to-1, but 1-to-4, and what have you. So it has to do maybe with the level of the perception of risk, the level of credit enhancement, let's say, that some investor would like to see to make a project worthwhile, and also the availability of grants as well. So you made a very important point when you talked about 80% of Africa's is the funding is done via the sovereign sector and 20% via the private sector. It needs to be inversed, and for that you were talking about the global financial architecture, and one of the key points has been how do we mobilize more the private sector, and I think that one role that MDBs, multilateral development banks, can play is maybe to provide another set of financial instruments, maybe take more risk in order to attract more private sector, give them the confidence, let's say, in investing in a certain part of in my case African businesses, and then have some kind of a demonstration effect. And once you have that demonstration effect, then it makes it easier for the private sector to come on its own. We all know, there's been a study by Moody's that showed for infrastructure development, the NPS, non-performing loans in Africa, and actually Africa was at the lowest rate of default on that particular project than Asia, than Europe, than the Americas. So reimagining the way that we work with the private sector. And on the debt pose, I think it's a very good idea for multilateral development banks. As you know, it's not something that we can do unless there is compensation received from sovereigns, but there is the climate resilience debt clauses, the CRDC, which has been spearheaded by the UK, implemented already by the Inter-American Development Bank, so a great blueprint for MDBs to participate in this. So if there is a specific climate-related event, but it can be something else, then we should be in a position not to burden the country more and provide a debt pose. So let me pause here.
Yes, thank you very much, Hazatu. So I see a lot of support for the agenda that Sara has just outlined. I think I've seen that Vera Zongwei has entered the webinar as well. Of course, you have not been able to see the presentation of Sara, but from your own work also with the independent high-level expert group on climate finance, what would you say about the statements that we indeed in this next COP28 should move from a discussion about billions to rather talk about trillions, and therefore broaden the discussion on the kind of like instruments and sources of finance that are within scope of the negotiations?
Thank you very much. My apologies for coming late. We were just doing the embargoed launch of our second climate report, talking exactly about these things, and so we had a couple of questions. So this is very timely and very important to have this discussion. My pleasure to be on the in this discussion with the rest of the panelists and see how we can together build on what is an important and pressing agenda. I think three things. We already moved to the trillions, right? And maybe the billions. When we talk about the billions, we're talking about the 100 billion Paris promise. I think one of the things we say in our report about that, just so that we can put that on the side, is that and the OECD has already released this data, so I'm not saying anything that is in the embargo report that you don't know yet, but OECD has suggested that we may have already met the 100 billion last year, and if not, we certainly will meet the 100 billion this year. So I think the conversation on the billions, as you say, we can gladly put to rest. I think something that we take pleasure in the report that Nick Stern and I had the pleasure to chair last year was really because the 100 billion which Nick was involved in setting was really the first time the global partnership had come together and said, let's do something. There was not an academic piece of work that was done to say, what are the numbers? How do we get to the numbers? And so we had the 100 billion. I think in the report we released last year, we had a very clear sense, and we did a lot of academic work. It was almost a deductive approach, which was to say, what is the problem? What is needed to solve the problem? And we came up with a number. That number last year, which is still the number we're using, is 2.4 trillion. So we have gone from the billions to the trillions. So it's $2.4 trillion that are needed to actually tackle the climate imperative. How do we split that? And we split that in two ways in the report. We split that first by, for what? What do we need $2.4 trillion for? We all know that the energy transition is the largest bucket that needs the most amount of financing, both in terms of reduction of emissions, transmission, transportation, and housing are the second two. Together, they account for 17% of the emissions, and that's a big part of the problem that we need to solve. And then we have adaptation and resilience. Adaptation and resilience, $250 billion are needed there annually between now and 2030 to be able to come to grips with this problem. We have loss and damage, which is a big conversation, and the Egyptian COP gratefully put it on the table, and we were able to, past midnight and past the closing of COP, and it's come up with a loss and damage facility that was put in place, or at least announced. And as we get into the end of the Egyptian presidency, because we still are in the Egyptian presidency to some extent, we have now finally agreed on the governance structure around the loss and damage fund, and sort of the contributions around that. There's no resources yet, so we may go back to can we fund this, and are we going to be able to fund it at scale? But for that we need about $300 billion. And as Hassatu was saying, there is already resources around that and commitments that have been made by different development banks and development institutions to do that. Now, and I've just given you a little bit of a sort of vertical breakdown of the 2.4 trillion, but there is the horizontal, which is, where do we find the 2.4 trillion? Who is going to, where will the resources come from? Of the 2.4 trillion for climate finance, 1.4 trillion we say will come from domestic resource mobilization, and another 1 trillion from external financing. And this is minus China, because even though China is an emerging market and developing economy, China has, we believe, sufficient resources to be able to fund, and as we see, and as it is doing, the top 10 solar panel industries in the world, the Chinese, the top 10 renewable industries in the world, the Chinese. So there is quite an activity there. So we leave China out of the sort of resource need and resource requirement as we go towards, as we look for the trillion. So the 1.4 trillion domestic resource mobilization, 1 trillion MDBs or 1 trillion external financing. Of the 1 trillion in external financing, the breakdown is the following: 200 to 300 billion will come from bilateral resources, is what we are assuming. 600 billion from the private sector, but this only happens and is only conditional on two things. One, good policies from countries, We say in the report that good policies are cheaper financing. So good policy is good finance in some sense, if you want to put it that way. But once you have good policies, we also need the multilateral development institutions. Today, the whole multilateral development institutions, international finance institutions framework is, generously about $130 billion worth of financing. We need to triple that to take it to at least $300 billion worth of financing. Then you can leverage the private sector. And if we're able to leverage the private sector with de-risking instruments, with guarantee instruments, working together to co-create, then I think we can actually deliver on the billion. So that's a little bit how we go from the billions to the trillions, and I think we're already there. Finally, the developed world has already invested just in 2022 $1.2 trillion for climate. So we've met the trillion, but it's in the developed world. We now need for some of those resources to be able to be put in the developing world to close the gap. Thank you.
Yes, thank you very much, Vera Zongwei. I think before you entered, the point that Sara made was that indeed domestic resource mobilization is a very big part of your report. Nevertheless, we are having these countries currently facing very high cost of commodities, high interest rates. A lot of them are actually in debt distress. So how credible actually is it that they will bring this money on the table through their domestic resource mobilization? Is there not a gap in that sense in the climate funding that actually needs us to think of different resources like the special drawing rights that we will dive into in the second part of the discussion? But maybe before we dive into that, Jesper Hansen of the Dutch Ministry of Finance, could you give your idea on whether we are indeed already moving towards the trillions and therefore need to keep going, or whether we actually need to find new tricks, so to say, in order to get enough money on the table?
Yes, thank you, Rens. And I think, first of all, I agree with Vera that it's good that at this COP, going into COP, at least we can show that on the billions we have a result. That it seems that the 100 billion climate finance commitment appears to have been met as of 2022. On the trillions, I mean, the report by Vera and Nick Stern shows that much more financing is needed. And I tend to agree with the report that there is an important role for MDBs, private sources, and domestic revenue mobilization here. Sara, in your presentation, you tried to put some realism into those estimates, and I think that's good. But in my remarks, I'd like to come out a bit more on the optimistic side. So first on MDBs, we started the evolution agenda at the World Bank last year, which calls upon the MDBs to increase their focus on global challenges, including climate. And especially at the World Bank, with the appointment of Ajay Banga, we see action there, and we also need to generate the financing needed for MDBs to be able to focus more on global challenges like climate. And here, as you mentioned as well, Sara, there is the review of capital adequacy frameworks, on which I think good progress has been made over the past year. This review, in essence, is about asking MDBs to take more risks on their own balance sheet so they can increase their lending volumes. Measures taken at the World Bank, for instance, so far include lowering the equity to loan ratio, introducing portfolio guarantees and hybrid capital. And this all sounds fairly technical, but it does translate in additional funding. So according to the World Bank, the measures they took so far resulted in $157 billion of additional lending room over the next 10 years. And we believe more should be done. So we're currently looking into clarifying procedures on callable capital, which is again quite technical. But if we clarify those procedures and we engage in discussions with rating agencies, that again might free up additional lending room, which can be used for MDBs to support countries in the climate transition. Another measure that we believe should be taken without delay is publishing the data of the Global Emerging Markets Database. This is a database about credit risks in EMDBs. And sort of what seems to be in the database is that actually risks are not as high as they seem to be. And the promise of publishing the databases and the expectation when we publish the database is that it might crowd in more private finance because it gives more clarity about risks of investments in EMDs. And that brings me to private sector mobilization. Clearly, just given the size of the challenge, private sector mobilization has to be part of the solution. We currently see high financing costs and uncertain returns. So firstly, better data is important. So this is why I refer to this GEMS database. But we also need to improve the business case for private investments in the climate transition. And for that, clear commitments about national determined contributions and long-term strategies are needed. And countries can also help improve their enabling environment for private finance. And instruments like the IMF's Resilience and Sustainability Trust can be important in this regard. Here the IMF assists countries in contributing to climate action and creating enabling conditions. Finally, on domestic revenue mobilization, I agree. I think also with what you said, Sarah, and you said it as well, has to do that it's not a panacea and it takes time. But a recent study from the IMF showed that there is untapped potential of 8 to 9% of GDP in low-income countries from moving to the best practice on domestic revenue mobilization. And well, even if you catch sort of half of those gains, that would already be massive. And related to this, we think there's an important role for Minister of Finance. The Netherlands proudly co-chairs the Coalition of Finance Ministers for Climate Action, which meets 3 times a year at the margins of the IMF, World Bank annual meetings, spring meetings, and at the margins of the COP. So there will be a meeting at COP in which we will build upon the climate action statement that has been published at the IMF World Bank annual meetings in Marrakesh, in which Ministers of Finance jointly published the measures they took for climate action, including, for instance, fiscal subsidies, carbon pricing, or reducing fiscal subsidies, carbon pricing, green taxonomies, green bonds, green budgeting. So there's a whole host of measures Ministers of Finance can and should take. And within this coalition, we try to exchange best practices, show proof of concept, showcase what works. And we believe it's just very important that finance ministers are part of the discussion.
Okay, thank you very much, Jesper. So I think we can conclude this first part of the webinar by stating happily that we are moving from the billions to the trillions. And there's no doubt about, no discussion about the fact that we actually need to have these trillions on the table. And also that despite all the important things that are moving forward, there is still a gap there that we need to fill. And for that, I would like to move then to the second part of this webinar, where we're going to focus a bit more on one specific potential instrument to fill that gap, which is the rechanneling of the special drawing rights. And for that, I would like to give the floor to Tirivangani Mutatsu to present the research that he has recently done about the use of special drawing rights in the African continent. Thierry, please.
Thank you, Reins. Thank you so much for the opportunity to share the study that the small report actually that we did with my colleague Adrian. Can you see my screen?
Yes, this is good.
Thank you so much. So we basically looked at the available IMF special drawing rights rechanneling proposals in terms of the opportunities and challenges that they present, especially from an African perspective. So you will find that in the report, we sort of give a an overview of how the SDRs were used in general in Africa, but also in few selected countries. We did provide a table where we are analyzing the various proposals so far on the table as they are. And as you are aware that some of the proposals and the models, some are old, some are very new, some are in operation, and some are yet to be operationalized. But our conclusion rests on the fact that we feel that the SDRs rechanneling through the MDBs, especially from our region, the African Development Bank, is the best option for us for various reasons that you find in the report. So yes, in general, we are aware that the African region received very little from the overall allocation that we given, 5%. And this is very small if you have to compare it to other G20 countries. When it comes to the usages, I think since the 2 years since the allocation, we have seen that most of the African countries have used close to 90% of their SDR allocations, especially for monetary and fiscal purposes. And there are so many ways: the COVID expenditures, supplementing budget, reserves, debt servicing, and economic recovery. We picked 2 countries for this presentation, that is Zambia, that basically received 1.3 billion. And they basically used part of it for balance of payment deficits, COVID expenditure, international reserves. And we also picked Rwanda because Rwanda is, as of now, received some funding from the RST, that is the IMF's new mechanism that has been recently established to help countries finance the fight against climate change. So Zambia accessed part of that funding, especially for climate adaptation and mitigation efforts, and also to maintain its macroeconomic stability. I think the details will be found in the report, but this slide basically shows what is currently prevailing in terms of the rechanneling proposals. The green ones are the ones that are in existence at the moment and presents options, especially for the SDR contributors. We have the IMF's Resistance and Sustainability Trust, the PRGT, we have the multilateral banks. In our region, we talk of the African Development Bank and this proposal for the hybrid capital instrument. But equally, we have other proposals coming from UNECA, the Liquidity and Sustainability Facility, and also the bilateral rechannel. I think these are some of the options that are available. When it comes to looking at these various proposals, we thought maybe we should have a look at the pros and cons of each against each other. So when you look at the IMF 2 trust funds, I think the major challenge we found was that the major pro we found was that, yes, the lending countries maintain their SDRs on their balance sheet as liquid assets, and this is great for them. But for the borrowing countries, we found the IMF conditionality issue. I think this is a big issue when you look at the countries that have been borrowing from the IMF through its various facilities. I think it's an issue with us in the report. When you look at the Liquidity and Sustainability Facility, I think the pro we found that is that it's a facility that can provide access to financing to a lot of African countries. And this can actually help in terms of accessing much needed resources for climate change expenditures. But one con we found is also the conditionality and the oversight issues. When it comes to the African Development Bank, I think one pro we pick is that I think the colleagues said that the bank has the potential to multiply the rechanneled SDR by 3 to 4 times. And I think this is important for us in the region because the resources are really needed and the bank can play that. But when it comes to the cons, you find that the slow uptake and maybe a bit of resistance from the contributing donors of the SDRs, especially in the West, can slow that the implementation of that proposal. In conclusion, I think we made quite a number of conclusions, where we are saying that yes, although the use of the IMF2 trust funds has an advantage of maintaining the reserve assets, we have an issue with the policy conditionality that can be attached. The RIST restrict entry limits. It includes quite a number of low and middle income countries, close to 70%, of which most of them have high poverty levels and most of them are vulnerable to climate change. Concluding, we say that we recommend, or we found that the African Development Bank hybrid instrument is very key. And we felt as also that the bank does not require much macroeconomic conditionality as part of its programming with borrowing countries. And the bank has the potential to multiply, as has been said. And after all, the bank is also a registered SDR holder, hence rechanneled SDRs maintain their reserve status within the bank. I think those are our main conclusions from the small report we did.
Yes, Thierry, thank you very much. I think very clear recommendations you put on the table. And maybe Hassatu Nzele from the African Development Bank, maybe you can add a little bit more on, well, maybe not too much the technicalities of the hybrid capital instrument, given the short time span that we have, and other speakers that we also still want to give some time. But what I'm very interested in is where are you standing currently with this proposal? Because as we know, most of the SDRs, if not all, currently are being rechanneled through the IMF trusts. But as Thierry presented, there are good reasons why you would want to have more of this through the multilateral development banks like the African Development Bank. So where is that standing at the moment? Thank you.
Thank you very much. And I wouldn't be remiss if I did not mention that I welcome the comments from Jesper when he talked about the CAF, and that was important, compelling, and basically validated our approach at the African Development Bank. Because when you have a relatively small capital in view of the formidable challenges that we have to face on the continent, you have to be innovative. You have to make your balance sheet sweat. And it's in that context that the SDR rechanneling and hybrid capital came. With this synthetic securitization, we've done portfolio guarantees. We've been really at the forefront of innovation, and the hybrid capital was one of the existing instruments that could be put to very good use with the MDBs. And it's something that we share with all MDBs, because the report talks about MDB collaboration, so we've been there. And hybrid capital was interesting because as we were working for hybrid capital, we saw that proposal for SDR channeling via MDBs, and to us it was almost a no-brainer, and that's how the work started. So it is innovative, it is new, and because it's innovative, it is new, and it's involved discussing with shareholders that are conservative. So it has taken some time, but we've had very good traction so far. Slower than I anticipated, but that's the rule of the game. We have to discuss, we have to explain, and in some countries it entails also changes in the rules and regulations. Thierry, thank you very much for your presentation, and you did mention the hurdles of the European countries vis-a-vis the European EU treaty, and basically this is the discussion. We have an ongoing discussion. And basically, we've tweaked our proposal so that European countries could participate in the SDR channeling via MDB's initiative by just providing a guarantees in their currency. So it's still work in progress, and I'm hopeful that we have an event during the COP28 on the 4th of December, leveraging SDR for climate finance and development, and we're hoping for some public pledges to come out of there. Thanks.
Yes, Hassatu, thank you very much. And maybe this then is a good moment to go to one of the countries that has put some pledges already on the table, being a front runner, both in the amount of SDRs pledged as the way to use them. So I'm very happy to have William Roos from the French Ministry of Finance also in the webinar. William, can I invite you to explain a bit on how from France you are looking at the rechanneling of the special drawing rights, in particular also with respect to multilateral development banks? Oh.
Yeah, so we can't hear your voice. Maybe try if you have like earplugs, that might help.
Is it better? Is it better?
Yes.
Yes.
Okay.
Now
So thank you very much for inviting me. It's a great pleasure to be with us. Indeed, this issue about SDRs has been one of the key priorities of France, together with the priorities of many other IMF shareholders. So first, to have this exceptional issuance of SDRs in 2021, and then indeed to magnify the impact of the SDR allocation in order for more SDRs to be targeted to supporting developing countries, notably on climate, but not only. So it was, I think, very important to first to strengthen the PRGT at the IMF, and it has been done through the SDRs loan and also through additional grants. We have also collectively created the new Resilience and Sustainability Trust at the IMF. And it's good to see that it's something concrete today because this new financial scheme has already committed about $6 billion for 11 countries, and it is projected to provide close to 30 billion between 2022 and 2025. As France is concerned, we are committed to channel 40% of our SDRs received in 2021, and we are very happy to see more and more countries joining us for at least 20%, and some of them even above us, above 40%. So it is needed first to continue to support PRGT and RST in the long run, but we also value a lot and are very happy with the proposal put on the table by Inter-American Development Bank and the African Development Bank. A lot of work has been done by Asatu and the colleagues at the African Development Bank and IDB. And we think that they have tackled many potential difficulties. It's clear that it could meet the reserve asset status. There are a lot of work has been done to assess how it can do that, notably with the minimum number of countries contributing. And we have also understood that some countries like France, as an EU country, we cannot provide today SDR loan to MDB. But what we can do is, independently of SDRs, we can support the guarantee and the guarantee scheme, which will be associated with the broad instrument. And indeed, France has confirmed that we are ready to be part of this journey. Very ambitious, but really important, and we are ready to provide this guarantee. So I hope that I hope this commitment could encourage other countries to contribute to the scheme. At the same time, I think that we should be clear that SDRs are very useful, but it's not a silver bullet for solving climate finance. So this is why I think all what has been presented by Vera Songwe and the other presenters were very important, and to work on the different layers mobilization of domestic resources, mobilization of private capital. And I would just like to mention that in the context of the last summit in Paris and the Paris Pact for the People and the Planet, we have among the different deliverables, there is a specific work stream on a new source of financing, notably international taxation. And we are fully committed to work with all over interested parties to create a consensus at political level in order to have this new source of financing on top of what donors have to do.
Okay, William, thank you very much. Indeed, as Sara also presented in her presentation, mentioned the taxation. So it would be great if in COP28 some steps could be taken on that, as on the debt pause, for instance. But given the time, I would like to keep the focus now on the SDR instrument, where we've seen that after the initial pledge of rechanneling 20%, which is around $100 billion US dollars worth of SDRs, France, but also Japan, for instance, has increased their pledge already to 40%, so doubling that amount. And I believe it was even Spain who said that they also wanted to match that 40 or even go to 50%. And I believe that in the call there is also Andrés Barragán of the Spanish Treasury. Andrés, if you are here, would you like to tell us a little bit about how in Spain the thinking is developing around the SDRs and the rechanneling? Andrés Barragán, are you there? And well, otherwise, if not, then let's, Jesper, can I ask you to elaborate a little bit more on how the Dutch position is on the SDR rechanneling? So what would be possible, for instance, in sense of increasing the pledge, which I think for the Netherlands still stands at 20%, and also maybe what do you think of the kind of like guarantees that France has entered into?
Yes, thank you, Rens. I think I started my previous intervention with the fact that it's good that the 100 billion on climate finance has been reached. I think it's also been very positive that the G20 target of 100 billion in SDR on lending has been reached. But clearly, I'd like to compliment France and other countries on their leadership to even go beyond the 20% of SDR on lending that amounts to the 100 billion. In the Netherlands, we believe indeed that advanced economies can do more with their SDRs, and we are looking into options of increasing the share of our on-land SDRs. So far, we provided SDR, on-land SDR, to the IMF Poverty Reduction and Growth Trust and the IMF Resilience and Sustainability Trust. And given the limitations that William also mentioned on lending to MDBs, if we would do more, we would increase our contributions to either PRGT or RST. And I think, Sara, you mentioned constraints on the capacity of the IMF to do more. There will be a review of the PRGT, and there will also be an interim review of the RST. And I believe that so far there has been overwhelming demand for RST programs. So I don't necessarily think that there's a constraint there. If anything, I would expect that in the PRGT review there will be a call for increasing the size of the PRGT, and I can imagine the same in the interim RST review. In response to Tirmangani's point on conditionality and the point about austerity and the negative signaling effect of conditions, I would also like to highlight the positive effects and the beneficial effects of the conditionality of the RST, because the idea behind RST conditionality is that the fund can help put in place the conditions needed to attract alternative sources of financing. And we've seen positive examples, like the case of Rwanda, where after the RST agreement, 300 million of additional financing was found from the EIB, the AFD, and CDP. So those are French and Italian development banks. So I think the RC has also proven that with its conditionality, other sources of finance can come in. On the LSA, so this instrument that William just mentioned, France is open to contribute to. We are a bit more hesitant here. The LSA resembles a similar instrument at the IMF, which is called the encashment regime of the Poverty Reduction and Growth Trust. And here it depends per country whether or not countries participate. And for the Netherlands, we actually don't participate in the encashment regime of the PRGT, because for us this is not needed to treat contributions to the PRGT as a reserve asset. So for us it's not the most logical step to provide a guarantee so that other countries can benefit from such a regime in case of the AFDB. But of course we are very positive about the initiative of the AFDB to try to unlock SDRs in countries that are in a position to contribute, or for countries that are in a position to provide guarantees for the LSA. More broadly, I think if we would need to decide on further guarantees on the budget, that relates to William's point on SDRs are not always a silver bullet. For us, it's not the most relevant question whether or not the guarantee that we could provide is a guarantee to an SDR contribution or another contribution. So I would weigh, for instance, a guarantee on an SDR contribution relative to, for instance, a guarantee to the portfolio guarantee at the World Bank, which has been introduced recently. And you see actually that those guarantees have a higher leverage of 6 times the amount of the guarantee provided. So although I think it's very good that AFDB is exploring these measures, I think for the broader discussion, it's also important to look at the other instruments that are available, such as portfolio guarantees at the World Bank, etc.
Yes, very clear. Thank you, Jesper. I was about to close, but of course, if Hassatu is raising her hand, I need to give her the floor. Hassatu.
Thank you very much. Just for Jesper, the reason why the leveraging, it's the same. So the World Bank has a leveraging impact of 6 because basically they have, because of the amount of risk that they're facing when they lend. We lend to the low income countries, so the riskier part of the world. So the set aside in terms of risk capital is higher. So the leveraging capacity of the African Development Bank is 3 to 4. And so basically, if you do an allocation of SDR to MDBs, it's going to be as per their leveraging capacity. The one from the Inter-American Development Bank is high. And I think that even Asian Development Bank is 8. So the leveraging capacity is the same. By participating in the LSA, you are participating in the SDR initiative because you're making it possible to to increase the allocation. So this is what I wanted to add vis-a-vis this. Thank you very much.
Yeah. No, thank you very much, Hassatu. I think this very nicely also illustrates where we are with this discussion. So I think everybody subscribes to how hugely important it is that we are able to use the euros, the dollars, the money we have as efficiently as possible, given the task that we're up to. And there is a lot of innovation going on. I think that's very important. And it's usually important that we keep this conversation going in order to make sure that there are no misunderstandings, no lack of information anywhere, so that we can actually make the most of the money that we have. And I hope that with this very busy webinar, we have added a bit to that clarity, given some new inspiration, maybe also as to new resources to look for. And especially I hope we have helped to set a bit more of the agenda that we will continue in Dubai at COP28, where we will need all the creativity and innovation possible to get the climate finance we need for an inclusive transition on the table. Well, with that, I would like to thank, well, first of all the participants to this webinar, and a special word, of course, to the presenters and the speakers of the panel. Thank you very much, and well, we'll continue this discussion. Thank you.
Thank you.